Momentum, however, the long-term momentum that we're monitoring, says that if you can close this week out just around yesterday's high, around 34.80, 34.90. Right now, I think we're trading, we speak, 34.55 or something. You close the week out around yesterday's highs, and I'm going to get a momentum breakout that says you don't wait for 35 or 36. It's going to go. Monetary metals are the place to be. Silver's been an underperformer. So have the gold miners. This is relative to gold, that is. They're underperformers. I think that's shifting. It's clearly shifted in favor of the miners versus gold over the recent action. Okay. Silver, I think, is making a turn in terms of outpacing gold again. It's very much underpaced gold over the last 3 or 4 years. I think it's about to turn from very cheap relative levels to gold. It was under 1% of the price of gold a month ago. Yep. Meaning if you divided an ounce of silver and an ounce of gold, it came up less than 1%. Okay, that's very low. In fact, in the last 50 years plus, 21 of those years have at least seen silver at 2% of the price of gold. So even if you just went to a norm of 2%, that's doubling in the current value of silver to gold. Okay, and I think we're going to do that. But as far as the net price action and the momentum action of the metals, they've been in uptrends, obviously, since 2015 with the silver and the miners have had a correction between 2024, which gold went sideways and then, et cetera, resumed. Silver's now pushing at this week's high up to 35 again. Didn't quite touch it. It touched 35 back last October and dropped. It touched 35 again in March and dropped. And now, and we had a cleansing drop. And so you can see that last plunge we had, that sharp one, that was early April. That's when everybody out there thinking, oh, silver must go down with the stock market. Okay. And so while gold pulled back single-digit percents then, silver dropped from $35 to $27.5. Much of that occurring in 2.5 trading days. So it was a real panic, an orgy. And it cleansed the price chart, meaning that low took out the December low. So anybody who had their sell stops below that last low got wiped out and immediately reversed back up. Okay, it was a bear trap. And now you can see we're pushing at the highs up there. Now, anyway, we got up to 34.97, I think, yesterday. If you touch 35 again on the using July contract, that's right. What's called on point and figure charts, price guys that keep those things, $1, $3 down ticks, $1, et cetera. It's a double top. If you go back there a third time, it's a triple top, but it won't be a triple top. It'll be a triple top breakout by touching 36. So the price guys are going to get all excited if you see 36 because it'll be a blowout of the prior dual highs. Momentum, however, the long-term momentum that we're monitoring, says that if you can close this week out just around yesterday's high, around 34.80, 34.90. Right now, I think we're trading, we speak, 34.55 or something. You close the week out around yesterday's highs, and I'm going to get a momentum breakout that says you don't wait for 35 or 36. It's going to go. Okay.
Wow.
And I think when you go, it's my assumption based on a variety of dynamics, not just silver, but also its relative performance to gold, that silver could gush past the old $50 highs of 1980 and 2011 and reach up into the mid-60s to $70 area before it even pauses. So in other words, I'm arguing the case here that if you push this beast up just a little bit more, and you're going to unleash it, and I don't think it's going to have any effect at $50. I think anybody who looks at those highs is meaningless. First off, those highs, when they occurred, were so phantom and so brief that they almost don't even constitute highs. In other words, you were up there like one day and you evaporated. I think this time when you got up there, you're going to blow it out and go into the mid-60s or so before you even pause. And it's not the end of the bull. That's just this surge. So anyway, that's the dynamics I'm looking at. Now, what's going on around it is what's important. We've got the dollar, which has been a non-player for a couple of years because it was stuck in a 7% range between 23, 24, and into early 25, between about 100 and 107. It briefly ran up to 110 one time in a brief false breakout, but basically was in a range. So you could see that clump of ink there, that quiet little clump of ink. It's a narrow range for 2 years. So it wasn't a factor in impacting other markets. There wasn't enough going on in the major Forex markets to have an impact on bonds or on the stock market. But in March, that first big down arrow you see there, the down candle, right in the middle of that range, we closed at 104.21 right there. Yeah, that was March close. We got bearish then. We said, okay, you've broken an annual momentum uptrend. You can't see it on price, but on momentum, you broke it. Now you're trading there, at 99, 98 level. You better get out of here. If you don't get out of here, this breakage is going to continue. And we think we're going to go back to the lows, at least. The lows being a couple decades ago down around 70. Yeah, anyway, I think that's about to happen. And then if that happens, the technicals argue it's already underway. The price chart has only begun to show it by taking out that 100 level. That will become a factor. It will influence particularly foreign investors who buy into U.S. assets like U.S. government bonds, or they buy U.S. stocks. As we know, they have over the last years. Foreign investment in the U.S. stock market's been higher than they've ever been. Well, if the stock market wobbles and if the dollar drops, well, what if we just drop from 110 down to 98, 99? So you've already had a 10% whack. But if you drop this thing another 5 or 10%, it's really going to start to impact foreign investment in dollar-denominated assets, which will further exacerbate situations there. The other market, I think, is far more important than the stock market, as we know, as Jamie Dimon is now talking about. I think even Warren Buffett is, the government long-term debt market. That market has the least, there's the yield chart. Okay, you notice you had this surge in yields. We got bearish on bonds back in 2020, in October 2020, down near the lows when the yields were much lower. We got bearish on price of bonds, therefore expected yields to rise.
Right.
And they did. And in fact, it was a collapse situation in price, or in the yields exploded into 2022. That's that first major surge you see there. And if you draw a line across the top of that high of that first rally, you'll see that all the action since, lowered a bit to the first rally back in 2020. Yeah, that one right there. That was the first surge in yields. You could draw a line sideways. There's been no relief since. In fact, yields have been higher. Okay, so even though the Fed cut rates during some of that time and then raised rates, it didn't matter. The long-term bonds did what they wanted to do. And right now they're pressing at all-time highs, multi-year highs in yields or lows in price.
Right.
We think this is the market that has the greatest crisis potential impact in terms of affecting certain major sectors in the stock market, for example, like commercial real estate, hence, therefore, bank market, the bank sector. So you can look at tech all you want, but if that commercial real estate market starts to find failure after failure, and we just had a major shopping center about 2 months ago, went under, the biggest shopping center in the U.S., I forget the name of it, $300 million default on debt. High yields are choking that category. And you did in April, you dropped yields. You'll notice there's a drop there prior to the recent surge a few months ago. And price got up to 122 on the T-bond futures, which looked like we thought that rally might have gotten up into the mid to upper 120s. It got to 122, but in 2.5 days, it collapsed. Yields rose, price collapsed to 111. So you dropped 11 full bond points. And you jack the yields back up there, and you're pressing the highs again. So this is a choking factor, not just to the bond market, but to the U.S. government debt market, but to the equity markets as well, because you can't maintain these high yields and not choke institutions and companies and so forth. The Fed knows that. In fact, the president of the Boston Fed, I forget her name, Susan something, about 2 months ago made a speech. No, it was in mid-April. Gave a press conference or a speech, and she said this, and this is like about a week after Powell came out and was real calm and happy with everything. She said the Fed has multiple tools to deal with the financial crisis. Well, I mean, Powell just said the week before, there's no financial crisis. Everything's fine. Economy looks great. Why would she come out and make a statement that we have, quote, multiple, not just rates, but other tools to employ to deal with a problem? What problem? Okay. Well, she admitted something. Yeah.
She let it slip.
Yeah. Well, no, it was undoubtedly an approved talk. I mean, I don't think she came out and said that off the cuff. Anyway, very telling. And, that means, QEs are in their back pocket and all these things they need to do, especially to defend their own government bond market. So if I were in the stock market right now, or in any market, frankly, I'd be looking at the T-bonds, because as that market continues up in yields, down in price, it's ultimately a noose for some markets and a goose for other markets. Because if that central bank panics, and this is a debt crisis beyond mortgages like in 2007 through 2009, it's worse than the dot-com top in terms of debt issues.